Do it on my way. I'm gonna show you what I'm going through. Get you out of your comfort zone. 'Cause I need more of the truth right now. It's time that you made your mind up. 'Cause lately all it ever does is change. It feels like we're only talking. Going round and round. We'll fight like no other every day. I won't stop like the others. I will stay. 'Cause now is the right. I'm feeling alright. I'm playing the game. I know I can win right now. So tonight is loving is like I'm walking tight. Good morning. Good morning. How are you doing? Instagram. I wanted to jump in here and say hello. Let me go live on all the channels. All right. Now I'm live here on all the channels. We've got you on Facebook. I've got you on YouTube. I've got you here on Instagram. And so do me a favor. As you're coming in, say hello. Drew Hitchcock is in the house. How you doing, buddy? Hey, Jillian. So good to have you. Listen, this was a spontaneous, unplanned, I'm going live just to chat, see if anyone's got any questions. I'm watching the market. We'll talk a little bit about the market, what I see in the market, and my thoughts around it right now. It has been a ride, what I think you need to do. And then I've got a couple questions that came in off the hotline. If you've got questions then that you're here now and you want to ask them, let me know. You can pop them into the comments, into the chat, or I might even bring you on live. We can get them answered and help you out. But I'm going to answer some of the questions. If you have questions and we're not live, you can go and you're watching the replay for any reason, go to askmelnow.com. Leave them there. We'll bring them up on here. These are where I'm getting these questions from. And let's go from there. But say hello. Let me know who's in the house, and I can't wait to do this. So here's the thing. Let's just talk about the market, what's going on, the economy, money, and some of the things that I think you need to kind of consider and maybe put some perspective to what's going on. Because if you just watch, if I brought up a chart of what's gone on in the last 2 days, you've just seen this it's like a downhill racer. It's just like, oh my God, we get little hiccups here and there. But the reality is that we've been going down for a while. And so what is that? What's going on? This volatility, how do you handle it? How do you protect yourself? What do you need to do? What are the things to consider? And so I wanted to just put some of this out there. Now, obviously, this is my CYA, all right? For those of you that are not one of my clients, okay, this is more information that you can take to your advisors. Make sure that you don't make decisions without good advice. It's not specific to your situation. It is information, and it's my interpretation of how to navigate this. But here's the deal. You've got a situation where inflation isn't coming down as fast as they want. Okay. Another way to put it is unemployment isn't going up as fast as they want. In other words, what the feds are looking to do is to see a slowdown in the economy. And the way they're going to see a slowdown in the economy is they're going to see that the inflation number is going down. Prices are coming down. And the way prices come down is people stop buying. Okay. And so, or we have extra supply. So we would see prices coming down. We would see unemployment going up, because think about what's happening. If all of a sudden there isn't the kind of purchasing, then companies aren't making the kind of money that they were once making, which means that their profits go down. And when their profits go down, what do? They start cutting things. And when they cut things, typically they cut labor. They'll cut marketing, they'll cut labor, that kind of thing. So they anticipate that we would see some impact on the unemployment rate. Yet we're at all-time lows on the unemployment rate. So Powell, our friendly dude Powell, who well, I have my opinions about it, but came out and he was testified in front of Congress for 2 days and basically said that they're not necessarily happy with how quickly and where they are right now. They gave an indication that they're going to raise rates and that they have not taken off the table the possibility of raising rates faster and longer. Well, that spooked the markets. That spooked investors because when you start to raise interest rates, it raises costs. It makes it more expensive for companies to operate. And when it makes it more expensive for companies to operate, it decreases earnings. Well, stock prices are driven by earnings. And so we expect the earnings to go down. All right. Now, we expected that they would do a 1/4 point increase this next go round, which this next go round is going to be next week. So we should hear what the interest rate increase will be next week. But they put back on the table the possibility of, instead of a 1/4 point increase, a 1/2 point increase. And if they go to a 1/2 point, what they've done is they were doing 1/2 point increases. They brought it back and said, hey, we're doing a little better. We'll go to 1/4 point increases. But now if they accelerate it back to a 1/2 point, it's probably going to spook the markets even more. So all this to say that we're in for a little bit of a ride. Volatility. Now, here's the challenge. Here's the thing that I want you to be careful about is too often we see what is happening in the recent time as permanent. Inflation's never been permanent, okay? Recession has never been permanent. Unemployment has never been permanent. Bear markets have never been permanent. Heck, bull markets have never been permanent, okay? But I can tell you that in the long term, the markets go up 8 out of 10 years. We just might be in one of those 2 years that market ain't going up. We got hit with one last year, and this one seems to be a little volatile too. So we need to look at it through the perspective of a longer term view to understand it, or we run the risk of getting emotionally engaged in the conversations around things that actually, when we move out, are temporary. Okay. Now, I'm not saying to ignore it because trust me, I'm making moves in our portfolio. We're doing things. There's opportunities there. But at the same time, what I don't want to do is make emotionally irrational decisions based on short-term things that go on. Is there going to be pain? Yeah. I mean, if you see what happened with the bank, SVB Bank, they had to shut it down. And part of that was because of the interest rates and people pulling deposits. They didn't have the deposits. And that thing's going to all unravel. But I think we're going to see a lot more of that. And so we need to be prepared. So some things I want you to consider is this. As you start to look at your investments, as you start to look at your 401k, as you start to look at your financial future, the first thing always is you got to work with a plan. Okay. You got to work with a plan. You know, I call it a cash resource plan. Here's what I believe. The challenge with most people, including myself early on, was that I would make money. It would go into my bank account. Then I would use the money to pay bills and do the things that I wanted to do. And whatever was left over was left over. And then I would invest. But see, I never gave the dollars in my account a job description. I never told it what it was supposed to do for my life. And so one of the first things to do is say, first off, what do I want for my life? What do I want it to look like? What is that? Not what do I want next week? What do I really want for my life and why? And when we become aware of it, when we become attached to it, when we become something that becomes emotionally compelling within us, that we start to look at our life and say, this is what I want. then we can put the price tag to it. Then we can sit back and say, great, if I want to be financially free, if I truly want to be financially free at this time frame, what do I need to do to make that happen? Because until we define the destination, we can't define the pathway to get there. And that's the thing that I think a lot of folks will miss. So the first thing is to understand where you're going and then craft the plan. Specific plan for your circumstances. If you've got kids, if you got kids going to college, if you have medical, all those things. And I get it. It may seem like a lot. And we have some tools, and we'll get some tools available to you to help with at least getting you in the ballpark of where you need to be. Then from there, we need to then start to look at, we now have a plan. And so now with the plan, we need to execute on the plan. Now, the mistake is this, and some people have heard me talk about this before. I think that we have a society that wants too much. I know you're probably going, what the hell does Mel mean? No, here's what I mean. We have a society that's willing to list out their wants. They call them New Year's resolutions. They call them goals. They call them desires, whatever it is. You list out all these wants. And so they put them on a want list. And then when they get to the end of the year, the end of the time, whenever it was supposed to happen, and it doesn't happen, they go, I wanted it, but it didn't happen. Okay, I'll put it back on the list, and we'll kick the can down the road. Here's what I mean by wanting too much. Creating a great list of wants is fine, but I think it lets you off the hook. What I want to see, and what I kind of coach my clients to do, is I want you to shrink that want list down to 3, maybe 5 wills. And what do I mean by that? I mean that you're going to make a declaration. I will do this. I will get it in. I will improve my relationship. I will improve my health. I will conquer this. I will, because that is a declaration. People don't like making declarations because it's scary, because that means that there's a commitment there. But I can promise you this. When you make a declaration, when you say I will instead of I want, you will see that your actions have to fit the declaration you just made. And so set the trajectory, know what the destination is, know what you want for your life, create the plan, and make the plan a declaration, not a desire. Okay? Make the plan a declaration, not a desire. Second, okay? Actually, that's third. From an investing, getting more tactical here, here's what I want you to do. One is, during these times when there's decline, when there's uncertainty, when there's potential job loss, when there's increasing interest rates, when there's increasing costs and earnings might be going down, this is the time to make sure that you have enough liquidity, cash in the bank, to sustain yourself. Okay? Now, I have a very conservative approach, in the sense that I want to see you have at least 6 months, and I tell entrepreneurs especially 9 to 18 months cash available in the bank. And that's a lot. However, it's not just the cash for the downtimes. It is the cash for the opportunities that are going to come. When we have declines, when we have potential recession, when we have market declines, what you're seeing is things go on sale. Which brings me to the next point. The things we should be looking at to invest in now are those that are good companies, those that we can anticipate will not go to zero. Okay. Now, I am not making any stock recommendations. I'm not making any investment recommendations, but do we think that Microsoft is going to go to zero? Do we think that Amazon is going to go to zero? Do we think that Google is going to go away? And there are funds that hold these things. And so what we want to do is make sure we have the liquidity to sustain ourselves in a downturn, but also the liquidity to take advantage of opportunities that come in as a result of declines. All through 2022, my team has been buying and putting more money into the market at lower and lower costs, because we know that the ricochet effect on the backside of the decline is going to put us way over the top. Okay, your average recession lasts 11 months. Average bear market, okay, average bear market is a short duration too. So the key is to make sure that you're in the game, but in the game right, that you're looking from a perspective, from a long-term view. The market, like I said, 8 out of 10 years goes up. Okay. And so at the very beginning, that's where I want you. I want to make sure you have a plan in place. I want to make sure you know where you're going. I want to make sure you have liquidity. I want you to make sure that you're looking at, and if you're investing long-term and in good companies. Okay, so that's kind of the lay of what I see going on in the market. It's going to continue to unfold. We're going to have ups and downs, and it's just something that we're going to need to deal with it. And if you're prepared for it, then you're in good shape to take advantage of the opportunities that come. If you have questions, if things come up and you're unsure, do me a favor, send them my way. AskMelNow.com. Post them in the comments, post them in the groups, reach out. Let's keep you going. More millionaires are made during down times than they are during up times. 80% of millionaires are first generation millionaires, meaning that they didn't inherit it, they didn't get it gifted, they didn't find it on the street. It wasn't some buried treasure. They created it on their own. 80%, 8 out of 10. Y'all can be in the 80%. Listen, the journey to financial freedom for you isn't going to be a straight line, just like any success. So we need to kind of move through it in a way that starts to prepare you for the ups and downs and take advantage of them so you can grow. Okay. All right. So let me answer some questions. If you have questions, post them in the chat. If you want to come live with me for me to work with you, totally fine. Let me know on Instagram. We can do that. But let me answer some of the questions. I've got a couple of questions I'm going to answer. I have a call coming up, so I want to make sure that I am ready for that call. But I wanted to jump in here and just hopefully end your week in a way that hopefully gives you some solace, some direction, and something to think about. Okay. So the first question that came in was, how do you choose, speaking of liquidity, how do you choose a high yield cash account? Well, let's first define what a high yield cash account is. Okay. For those that maybe aren't aware of it. If you invest cash, or you're saving cash in a bank account, it's probably getting you 0.2%. It's getting you very, very little. Now, as the interest rates are going up, the one benefit of interest rates going up is that your interest rate on your savings accounts will be going up. Interest rates on bonds will be going up. All of those things are going up with it. Okay. And so what you can get access to is what we call a high yield cash account, a high yield savings account. A lot of times it's at online banks that you can get a decent rate of return. We can get over 4% on cash in the bank now. Well, 4% is not bad. It certainly beats 0.2%. So if we're parking cash for liquidity, for protection, to the emergency fund, all of those things setting aside because we need it in the short term meaning 5 years or less. We don't want it in this volatility of the market, so we need to park it somewhere. We might as well make something. We want it in a high yield savings or high yield cash account. Okay. There's 3 characteristics I want you to look for in a high yield cash account. 1, it is higher yield. Okay. It typically we can get 3.5 to 4.5% currently, and if they continue to raise rates, then those rates should go up. Okay. 2, it is 100% fully liquid. Okay. It is 100% fully liquid. That means that all I got to do is log in, transfer the funds, and I have access to them. It isn't locked up for 6 months like a CD or anything like that. It isn't locked up for a month. You have absolute unfettered access to the funds. It might take a day or so because of the transfer and all that stuff, but you have access. Number two is to make sure that there are absolutely no fees. Okay? You're putting your money in their institution. They shouldn't be charging you to have your money because they're going to make money on your money. All right? So there should be no fees. And number three is it should be 100% insured. Okay? With the downfall of Silicon Valley Bank, this should raise the need and the understanding of why we want our funds that are in banks, in deposit institutions, insured, because those folks are going to get paid out at least up to the FDIC limits, hopefully, because the bank was insured. I want to make sure that your liquidity is insured. Now, the typical insurance is up to $250,000. If you're putting more into a bank than $250,000, and sometimes it's aggregated, so you got to look at it, you may have to separate it and go to other banks. Okay. Now, some of the high yield cash accounts, actually, because of the way they're structured, have insurance beyond $250,000. They have insurance up to, well, Wealthfront has insurance up to $2 million. Okay. So let's revisit it again. One, it is 100% liquid. You have access to it. Two, it is without expenses or fees. And three, it is fully insured. Those are the characteristics that I look for in a high yield cash account or high yield savings account. If it doesn't have one or any of those things, they don't get my money. All right. They don't get my money. All right. Someone's asking which ones do I use? This is not a recommendation, but full disclosure, I have money in Wealthfront. I have money in CIT. There's Truist Bank that you can use. There's a number of them. Go to bankrate.com and you can see what the rates are. Now be careful, because sometimes you'll see this high rate, but it's for the first 5,000 only, or it's for the first 3 months only. It's a teaser rate to get you in the door. Don't fall for those. You want a rate that's going to stay there. Now, always understand that these high yield cash accounts, they will go up and down based on what's going on in the market. So if interest rates start to decline, then the rate on the account will decline. So you will adjust accordingly based on that. So that was one question. And then the other question that came in that I want to answer is, if I'm going to buy a home, can I go and buy, can I buy a larger, more expensive home if I intend to get a roommate? This is such a good question. And here's the thing. I want to differentiate between getting a roommate and house hacking first. House hacking is I get a duplex or a triplex. I live in one, and there's a separate unit or separate 2 units that I rent out that cover the costs of the house. That's typical house hacking structure to do it, and you can do that. A roommate, that person is in your house. They're renting a room. It's a different game. All right? Couple things before I even give you direction on this. One is to understand that when you get a roommate or you house hack, you are no longer just a homeowner. You are now a landlord. And when you become a landlord, you carry with it some legal issues that can come into play. So you want to be prepared to understand what the landlord-tenant laws are in whatever state you're in. And this is guy's name is Michael. I don't know what state you're in, but you want to understand the rules, because once a roommate gets in, or once a renter gets in, a tenant gets in, it may be hard to get them out. Now, I'm not saying not to do it. I just want you to go in eyes wide open so you understand the dynamics of it. Because if a renter doesn't or can't pay rent and you can't get them out, you still have to make the payments. So could you use a renter or a tenant to offset the higher cost of getting a more expensive property? And the answer is yes, if the tenant continues to pay. But if you're not prepared for the fact that maybe the tenant doesn't pay, or the the property goes vacant for a little while and you don't have that kind of cash available to you, then getting a more expensive property maybe not the right thing to do. So, and here's the thing I'm going to tell you to do. If you haven't watched it yet, before you think about getting a roommate, I want you to go watch the Netflix series. It's a documentary series called The Worst Roommate. It's horrible. It will freak you out, and you probably will never get a roommate. Okay. It's crazy what some of these folks did. But I want you to go in eyes wide open. I'm not one that will typically tell someone not to do something. I am simply wanting to have people go in wise eyed open, be fully aware, fully conscious, and be intentional with the choices they make, with how they invest their money and what they do. So, to your question, if I get a roommate, can I get in a more expensive house? Generically, yes. But you got to cover whether that roommate is, if you can't rent it or the roommate can't pay. And what are the legal elements of trying to get someone out at that point? And can you cover the cost during that time? Because the bank isn't gonna wait for their mortgage payment. Okay. Two, if you're going to buy a property, you want to buy it. They say location, location, location. But if it is something that you want to use as a personal residence, understand that there's friction costs going into the property, the buying costs, the selling costs, the commissions, all those things, and getting out of the property. So getting in and out of a property can be expensive if you're not careful. You got to think about that. So if we're looking at a property, I'm going to tell you that you want to look at it long term. You need to be able to be in that property for 5 to 7 years, or you're going to turn it into a rental and keep it, because to recover the costs in and the costs out, it needs to be a long-term investment. 3, understand that if you have not taken, and we follow something called the wealth priority ladder, if you have not done the priorities there, why do I want rent or real estate as something after the, little higher up on the ladder, is because if all I have is $100,000 to invest or $50,000 to invest, and I put it into one property, then I have no diversification. So if that property value declines or the tenants don't pay or anything, it's the only investment I got. So at the beginning, I actually prefer having people go into either a diversified portfolio like a real estate investment trust or something where you got multiple properties and you're not exposed to one property, or to invest in other things like ETFs and index funds that give you liquidity and diversification first before we start to invest into a single property. And again, I'm not telling you not to do it. I am telling you the things to be careful about so you can be fully aware. And then the last thing that I'll say on this is that when you go to buy a piece of property or a home, primarily a residence, I want your housing costs never to exceed more than 30% of your income. 30%, no more. If it's more, then you run the risk of having issues if you have an income problem or a tenant problem or anything like that. So I hope that helped. With your decision. If you have more specifics around it, let me know. Reach out to me. Go to askmelnow.com. Shoot me some questions. Let's make sure that we keep you on this path to financial freedom. So those were the questions I had. I have another call coming up, but I wanted to jump in here, go live, because I haven't been live for a little bit. It's a Friday. We've had a volatile market. The market's now going down again. Who knows where it's going to be? Stay the course. Have a plan. Know that you're not alone. Stay on the journey with me. See if you've got questions. Let's make sure that we can help you out in the process. All right. So I'm going to hold on for a little bit. If there's questions, on either Facebook, YouTube, or Instagram. Let me know if anyone wants to come on live and have a conversation. Let me know. It looks like Silicon Valley Bank, I just got a notification, dropped to 31 cents a share. So it is beyond done. I can't even get chart data on it. So go figure, because it's shut down. But that's it. Y'all, if I don't get a chance to chat with you, know this. I'm here for you as you're doing what you're doing, whether it's business, whether it's money, whether it's life, whatever you need. Let's do this thing, and let's make sure that we don't do it alone. Let's do this thing together. We've been solid long enough. Let's come together. Let's walk this path together. Let's talk about financial freedom. Let's talk about the money stuff that no one wants to talk about, because in there is the generosity to give to life and give to people in a big way. All right. And so with that, I'm just gonna sign off as I always sign off. I want you to look at your life. I want you to look at how you show up in your life. I want you to bring in the wills instead of the wants. Make the declarations that will change your life and change others. To find the legacy factor that matters. The legacy factor in my world is how do you? It's closing the gap between how good you are today and how good you're capable of being, because where we are today doesn't mean that's all we're meant to be. And with that, always strive to live a life that outlives you. See you soon. Cheers.